In early 2025, President Trump launched a full-throttle tariff blitz, hitting China with a blistering 145% hike. But instead of putting the brakes on Beijing, it sent shockwaves through Washington's own garage of global allies. With China striking back at 125% in Europe and Canada questioning whether it's time to switch lanes toward Beijing, the US may be watching its trade convoy break formation. The question is, how did we get here, and what's this detour doing to the auto world? Trump's latest tariff offensive aimed to muscle China into a corner, but instead it kicked off a domino effect that's stalling engines across global markets. On April 2, his administration hit China with sweeping levies on everything from semiconductors to industrial chemicals, topping out at a whopping 145%. His justification? National interest. The result? Market mayhem. Wall Street coughed up billions in value. Oil prices nosedived for a second straight week. Asia's major indices suffered their worst blow since 2008. But the financial burn was just the beginning. In true tit-for-tat fashion, China countered with a 125% tariff on all U.S. imports and a not-so-subtle invitation to the European Union: unite against America's economic bullying. President Xi's diplomatic jab landed squarely in Brussels and echoed across the continent. His message was clear: there are no winners in a tariff war. Stick with the U.S. and you're signing up for economic turbulence. Traditional allies like the EU and Canada are now eyeing their options. For the EU, Trump's heavy-handed strategy has undermined trust. For Canada, it's a signal to rethink its long-standing supply chains rather than risk being collateral damage. They're exploring new trade routes, and China is starting to look more like a pit crew than a rival. Trump's tariff torpedoes didn't just sink China's mood, they rattled North America and Europe's economic chassis. The EU and Canada move over $1 trillion in trade with the US annually, with $700 billion from Europe and $300 billion from Canada. But instead of partners, they're feeling more like punching bags in a political demolition derby. In Canada, the mood has shifted. Hopes of policy stability post-Biden have stalled. Energy exports, oil, LNG, hydroelectricity, have long flowed freely into the US market. But now Ottawa's looking east. Talk of new pipelines, LNG terminals, and long-term deals with Asia and Europe is heating up. The goal is to diversify routes, stabilize revenue, and never be blindsided by Washington again. Public sentiment backs this pivot. Surveys show nearly 60% of Canadians now favor building infrastructure aimed at non-US markets. On the other side of the Atlantic, Europeans, especially in Germany, France, and Italy, are openly fatigued by US tariffs on vehicles, agricultural products, and tech. Internal EU documents hint at a realignment strategy that could reduce US trade reliance in favor of, you guessed it, China. Even President Macron chimed in, calling Trump's 90-day tariff pause nothing more than a weak handshake before another slap. Beneath all of this is a deeper issue: trust. And for both Canada and the EU, that trust is running on fumes. The once dependable engine of North American and transatlantic trade is misfiring, and the repair bill could be huge. China isn't wasting any time staring into the gap left by US trade tensions. President Xi's diplomatic push, courting leaders from Spain to Saudi Arabia, signals that Beijing is playing the long game. And so far, it's paying off. The EU and Canada are warming to China's advances. Beijing dominates critical supply chains: rare earths, solar components, EV batteries. European automakers see expansion in China as a smart hedge against US instability. Many are already ramping up operations there to avoid future tariff turbulence. Canada, meanwhile, is eyeing China as a new destination for its energy exports, with nearly $100 billion in oil and gas revenue on the line. With US trade flows under threat, Canadian officials are exploring long-term deals with Chinese buyers who offer consistent, large-scale demand. Yes, there are concerns. China's record on human rights and intellectual property remains a sticking point, but in trade circles, pragmatism is outpacing politics. The new strategy is clear: diversify. Reduce over-reliance on any one market, even if that means cozying up to a rival. And if the US doesn't adjust its strategy soon, it may be watching its crown slip further. The trillion-dollar question is whether the US can hold on to its status as the world's trade hub. Trump says yes, but Wall Street and America's allies aren't so sure. Analysts warn that even a 5% annual drop in trade with the EU or Canada could cost the US hundreds of billions over the next decade. As factories shift, pipelines get rerouted, and long-term contracts move overseas, America's grip on global commerce loosens. Bolt by bolt, recession fears are rising fast. Goldman Sachs now puts the odds at 45%, fueled by tariff turmoil. The S&P 500's 15% slide since February signals a market running on fear instead of fuel. Trump loyalists call tariffs a negotiation tactic, but global partners are no longer buying it. Meanwhile, China's pitch is simple: we're consistent. While it's no saint in the eyes of the West, Beijing is increasingly seen as a stable trade partner, one that honors deals and delivers volume. Even if the US isn't completely sidelined, the shift toward China has begun. And if Washington keeps shifting gears mid-race, allies may peel off, not out of spite, but survival. Trump's aggressive tariffs may have started as a high-octane power play, but they appear to be accelerating a slow drift away from American trade dominance. What was intended to isolate China might be isolating the US instead. As allies turn toward Beijing out of economic necessity, the risk is no longer just about trade imbalances. It's about influence, access, and leadership in shaping the future of industries like electric vehicles, energy, and tech manufacturing. This isn't just a policy shift. It's a strategic inflection point. The automotive world, driven by complex global supply chains, doesn't wait for political tides. Companies are moving where the parts are, where the demand is steady, and where governments provide predictable trade terms. Tesla has already increased its investment in Chinese battery production. German automakers are securing deals in Asia to circumvent US tariff zones. And Canadian energy firms are locking in long-term export commitments to East Asia, decoupling slowly but steadily from US reliance. Beyond economics, there's a growing reputational cost. Allies are beginning to question whether the US is a reliable long-term partner, especially when domestic politics drive erratic international policy. With nations like Germany discussing joint ventures in Asia and Canada diversifying its energy portfolio, the long-term consequence could be a multipolar trade world, where Washington is no longer the first call but one of many options. Meanwhile, automakers are adapting fast. Tesla, BMW, and Toyota are quietly shifting production and sourcing strategies to buffer against US-centric shocks. If left unaddressed, this could spell the beginning of a broader economic realignment where America, once the anchor of global commerce, becomes just another player in the race. The real twist? This quiet pivot could reshape the future of automotive supply chains, EV battery sourcing, and global energy routes. Even without a dramatic break, gradual shifts in trade relationships could bleed billions from the US economy and hand China a bigger seat at the global table. In trying to isolate Beijing, the US may have accelerated its own isolation. For many of its allies, diversification isn't just smart, it's essential for survival.